Aerospace and defense ETF soaring? For a bold trade in this sector, trade DFEN, Direxion's Daily Aerospace and Defense Bull 3X shares. Don't miss your next big trade. Direxion Leveraged ETFs.
An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direxion shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit us at www.direxioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors, such as traders and active investors. Distributor, Foresight Fund Services, LLC.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
All right, coming up on today's program, I'm going to give you some rules for speculating, and we'll also talk about whether that's an evil thing to do. Financial speculation has been demonized, but I'm going to give you some context and rules for how to go about speculating, so stay tuned for that. Also coming up on the show, we're going to give you a recap of what's going on in global financial markets. We'll take a look at the major asset classes and tell you how the ETFs tracking them are performing, as well as your emails and tweets. If you'd like to join us, 844-305-7800 is the number. Do give us your first name along with your city. You can also tweet the program live at Index Show is my handle. That's where you find us on Twitter. Follow us 24/7 there. And we'll get you caught up, too, on what's been going on the Twitter feed. Taking a look, though, at market action, where are we at in terms of performance? Well, we've got the S&P 500 along with the Dow Jones Industrial Average hitting record highs once again. We saw the Dow. The Dow was really the leader, and it closed at a record high of 26,656. It's just a number. Don't get scared. As I like to say, 99% of all statistics only tell us 49% of the story 100% of the time. So don't get scared by the stats. Don't let the stats frighten you. It's just a number. But the main thing what we see in the stock market, at least here in the U.S., is a bullish backdrop with prices continuing to march higher. Now, the S&P 500 also following that same trend. We've got major indexes along with, besides the S&P 500, other major indexes like the NASDAQ also doing pretty good. We're also going to get you caught up on what's going on industry sector-wise, so stay tuned for that. We'll get you a rundown of what's happening there. So getting back to this topic of financial speculation, speculation in financial markets, I think, carries hugely negative connotations. For the broader economy, speculation, especially by Wall Street's heavy hitters that control trillions of dollars in leveraged contracts, that poses systematic threats. We know that. It happened in 2008. Financial system nearly blew up itself. Too much speculation. Too many risk controls that weren't really controlled. And so we know that that's dangerous. But in the context of the individual investor, you and me, speculation poses the risk of large losses that may never be recuperated. That's the fear. That's the danger. But in both cases, whether we're talking about individual investors or we're talking about the heavy hitters, the institutions, is speculation something that should be absolutely all the time avoided? Because that's what many financial experts, many financial talking heads say, that speculation is bad. and you should not engage in it. And so what I'd like to do is just counteract that, because I believe that it's a very dogmatic and populist view that people should avoid financial speculation whatsoever. So I think it's cynical also, in addition to being dogmatic. I think it's one-dimensional. And I also know that it omits the fact that speculation on very rare occasions can result in a huge financial payoff. So can we think of any examples of speculation where there's been a huge financial payoff, where it's paid to be a speculator? Can you think of anything? Well, I can. What about Bitcoin? There's a perfect example. Cryptocurrencies. Anyone that purchased Bitcoin 5 years ago, it was trading near $125 a coin. And if you held it, you have a 5,000% paper profit. Now, that's a pretty incredible run. And that's even after Bitcoin has experienced this almost 70% crash from December until now. Even if Bitcoin was to fall 95% from its all-time high, it's off about 70% right now, but if it was to fall another, let's say, 25%, these speculators who went long 5 years ago would still have an almost 800% return on their capital in just 5 years. Now, for perspective on just how good that is, the SPDR S&P 500 ETF, which ticker symbol SPY, has gained just over 300% over the past 20 years. You've had an 800% return for speculating on cryptos in just 5 years. So to suffice to say that this example, and there are others, but this disproves the false argument that speculation is not a worthwhile exercise. We see that it can be a worthwhile exercise. The profit potential for speculation is very high. Now, we have to look at the other side of that coin. These wonderful results for some speculators, and it's a minority, it's not the majority, that's very important. There's a very high failure rate when it comes to speculation. Far too often, financial speculation is a losing proposition for most people, whether it's betting money on a promising startup, whether it's lottery tickets, whether it's that can't-miss initial public offering, or a hedge fund with a hot manager, a mutual fund with a great historical track record, whatever it is that you're speculating on, most of the times that's going to result in some financial pain of some sort. And so it's with this in mind that I think we need to build a framework for financial speculation, because the opinion of this person, myself, and the opinion I want you to have is that financial speculation, you can do it. You can engage in it, but it has to be within a controlled setting. It cannot be in an undisciplined manner, as most people practice. Financial speculation has a huge, huge payoff. And so on today's program, I'm going to give you a framework for financial speculation that I think will provide you with that opportunity of upside, while at the same time minimizing the potential for catastrophic losses. And what are catastrophic losses? Catastrophic losses are when you blow yourself up. When you blow yourself up completely and there is no tomorrow. That's what I call a catastrophic loss. So we can't have that. So we're going to get into that on today's show. Rules for financial speculators. And also want to discuss, before we even get into that, just the difference between speculating and investing, because I don't think a lot of people really understand those differences. 844-305-7800 is the number. You're listening to the Index Investing Show. I'm your host, Ron DeLegge. So if you'd like to join us, we're here. @Index Show is my Twitter handle. We're going to get you caught up on what's going on there on the Twitter feed. Also, I want to share with you what's going on industry sector-wise, what some of the top sector ETFs are doing thus far in 2018 as we begin to enter the final inning of 2018. Yes, this is the final part. This is where it all ends for 2018. So look, see, and compare your performance versus some of the indexes that we're going to talk about. I'm Ron DeLegge. This is the Index Investing Show, and we're here. If you'd like to join us, just give us your first name along with your city. Again, 844-305-7800 is the number. @Index Show's my Twitter handle, and I'll be right back after this short break.
The Index Investing Show with Ron DeLegge.
Have an investing question for Ron? Call 844-305-7800 or send your questions to @IndexShow on Twitter.
All right. So what I'd like to do is give you some big picture perspective on what's going on in global financial markets. The way we do this exercise is we tell you what are the major indexes and the ETFs tracking the broad asset classes. So we look at this at a big picture level. Stocks, bonds, commodities, real estate, those are the major asset classes, what I call the four biggies. And then, of course, you've got cash. That's the fifth major asset class. So right there, you've got the big five major asset classes. So let's just take a gander and see what's going on. Now, we slice up stocks in terms of whether we're talking about domestic stocks or international stocks. So if we just look at on the domestic side, here in the U.S., total U.S. stock market, ticker symbol VTI, is ahead by just over 11% since the start of 2018. So the question then is, how does that compare to international and emerging market stocks? Well, the answer is it's a great return because emerging market stocks as a group since the start of the year are down just over 8%. VWO tracks that area. International developed market stocks, we're talking about countries that are peers to the U.S., places like Canada and France and England, as a group have performed. They're almost down almost 1% on the year, a flat return. So VEA tracks that area. So you can see the U.S. is really the leader globally. The only other area that's up or positive this year has been Japan, and it's been a marginal gain, not even up 2%. So the U.S. really leading the way. The question I know for you bears, right? You bears are saying, well, listen, how long can this continue? Is the U.S. going to lift up the rest of the world, or is the rest of the world going to drag down the U.S. in terms of stock market performance? And I know you bears, that's what you're asking. That's the same question I'm asking. And it is a concern. We'd like to see more of a broad participation globally in the equity rally. We don't want to just have one country leading that rally as we do now, but it is what it is. And so until we see weakness in U.S. stock prices, considerable weakness that sustain a jump in the VIX, then all bets are off, and it's okay to be a bull, at least in the short run. Now, in terms of other major asset classes, we got global real estate, ticker symbol REET, ahead by about 1.75%. That area's been doing good. And then two other areas that are moderately negative are U.S. bonds down about 1.85% and commodities down 1.25%. So that's your global picture. Stocks are leading all asset classes, and the rest are either flat or negative by comparison. So the thing that I would like you to do is to look, see, and compare the performance of your own investments versus some of these benchmarks. How has your money performed so far this year? How has it done? Now, the way that you calculate this correctly is you subtract any additions that you've made to your investments. You factor in any withdrawals that you've made so you don't get a skewed return. And you look at what the performance, what the starting point has been of your money up until now. And then you calculate the percentage gain or loss. It's a very simple exercise. Now, this is what we do for listeners. We do free portfolio report cards. I will analyze and grade your portfolio. I won't just look at the performance. I'm also going to look at the cost of your investment portfolio. I'll look at the risk of the investment portfolio, as well as the tax situation and the diversification. And then we look at all those 5 factors in conjunction with each other and give you a final grade of A, B, C, D, or F. So if you want to get a portfolio report card analysis, it's a 1-page report, go to portfolioreportcard.com and get in touch with me. Now, in terms of industry sector performance, we'll get you caught up on what's going on there. A lot of really, really good things happening for sector investors, performance-wise. So stay tuned for that. 844-305-7800 is the number. At Index Show is my Twitter handle. Just by way of reminder, if you ever miss our regular radio broadcast, you can pick up our podcast. It's available at our website, indexshow.com. You can also find us on iTunes. Just search under the Index Investing Show. And you can also find us on Google Play as well as YouTube. So all of those places we are broadcasting this show. You can listen to the archives. Just go there. So getting back to our conversation of speculation, I want to give you some rules for speculating. As we discussed in segment 1, speculation is not bad. Speculation can, in fact, have a huge financial payoff. The problem, though, is that the odds of success are very low. And so for that reason, the likelihood is you'll lose your money on speculation or speculating. And so with that in mind, I want to give you a framework that I think can help you to still go after that opportunity, but at the same time minimize what we call catastrophic losses. Losses where you cannot recover from. So the first lesson is this. You need to understand the difference between speculating and investing. And to me, it's really shocking at how many both professional and non-professionals in terms of investment still can't distinguish the difference between investing and betting. Although both activities may seem like they're the same thing, they are not. And one of the best definitions I've ever heard of speculation was written by a gentleman by the name of Fred Schwed Jr. in his classic book called Where Are the Customer's Yachts? This is how he described the difference between speculation and investment. Speculation is an effort, probably unsuccessful, to turn a little money into a lot. That's speculation. In contrast, investment is an effort which should be successful to prevent a lot of money from becoming a little. So in monetary terms, let's put that into give you an example of what this means, the difference between speculation and investing. If you're trying to turn $1,000 into $25,000 in the course of a year, you are speculating. Now, on the other hand, if you're trying to get a $1,000 return on your $25,000 purchase of laddered bonds, well, you're investing. Why do we say that? Well, the odds of success in the first endeavor is going to be approximately 25 to 1. Very low odds. Whereas the second activity is roughly 1 to 25, a much higher chance of success. And so that's the difference between investing and speculating. It deals with what are the odds of a financial payoff, right? Speculation, the odds are very low. The payoff is extremely high, but the odds of that happening are low. In contrast, investment has a lower payoff, but a more probable chance of success. So understand the difference between speculating and investing. It's all about odds, as with most things in life, right? When you first dated your spouse, right, it was all about odds of whether that would continue, that relationship, whether it would flourish and become a marriage or not, right? It's all about odds. You did everything in your power to make the odds work in your favor, right? You got, if we're talking about a beautiful lady in your life, right? You bought her flowers. You charmed her with sweet talk, with dinner. right, with excursions. This is what you did to increase the odds of success that she would become your wife. And so in a similar sense, when you're investing, we want to set that up. We want to make sure that we turn those odds in our favor. And same thing for speculating, right? We want to speculate on not just payoffs that are high, but also try to turn the odds into our favor, as hard as that is to do. So we're going to talk about actual rules coming up next for speculating. Hang with us. I'm Ron DeLegge. I'll be right back.
The Index Investing Show with Ron DeLegge.
Are emerging markets on the move? For bold trades on emerging market stocks in either direction, trade EDC or EDZ. Direction's daily MSCI Emerging Markets Bull and Bear 3X shares. Don't miss your next big trade. Direction leveraged ETFs.
An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit us at www.directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors, such as traders and active investors. Distributor, Foreside Fund Services, LLC.
Stop investing blindly. Listen to the Index Investing Show with Ron DeLegge every week on iTunes and IndexShow.com. Learn how to grow and protect your money.
All right, welcome back from the break. I want to get you caught up on what's going on industry sector-wise. And if we dissect the stock market, we like to do that, right? We like to dissect the stock market, take a look at it, not just at the surface, but underneath, what's going on? What's really driving returns? And to do this, to really understand this, we need to look at what's going on industry sector-wise, which industries are pushing stocks higher, which ones are leading. And right now it's been the technology sector, ticker symbol XLK. That particular ETF is ahead by almost 18% since the beginning of the year, which is an outstanding return. We told you earlier the broader stock market's up about 11% this year. Well, here's a return that's up 18%. So we see significant outperformance there from the tech sector. And then, as most of you should know by now, we told you there's been some reshuffling within the S&P 500. The former telecom sector is now called the communication services sector, and that's ticker symbol XLC, which has also been doing pretty good. You got some of those high-flying companies that were formerly classified as tech companies, but some of those communication companies, you've got, for example, Twitter and Facebook and Google parent Alphabet, those are now all part of the communication services sector ETF. That's ticker symbol XLC. So that sector is doing okay. You got financials, ticker symbol XLF, which are up 4.25%, and as of late, perking up. And higher interest rates have been sparking that sector that, hey, that's going to be better for banks as well as insurance companies' bottom lines. And then you've got XLV, which is another standout performer. That's healthcare. XLV is in Victor, ahead by just over 15%. That group, of course, including those pharmaceutical companies, some of the larger biotechs, as well as the hospital and medical device makers. So that's what's going on sector-wise, your big picture view. And we're get you caught up on what some of the leveraged ETFs are doing, what's hot, what's not. So stay tuned for that, because if you think the performance in industry sector ETFs has been great, we just gave you some great numbers. You should see what the numbers are for some of these leveraged products and ETFs, because if you've been trading them and you've been in these sectors trading the momentum, you've been able to capitalize on that, and that's what we want to see. You've been speculating correctly. in the context of today's conversation. So 844-305-7800 is the number. We're here if you'd like to join us. Give us your first name along with your city, and we will do that. Now, on the Twitter feed, at Index Show, we've got a couple of things that want to make you aware of. First of all, speculation. Look at what's going on with marijuana stocks. Not a subject that we talk about often. But, man, what mania we see with some of these companies. One of them is called Tilray, TLRA, which has gone from about $18 a share. It topped out at about $300 a share. It's now back to, where is it, at about $120, somewhere in that range. It's bouncing between $100 to $120 a share. So these marijuana stocks, this is what I call the Cheech and Chong trade, which has replaced the FANG trade. Remember the FANG trade? That was pretty hot, right? FANG being an acronym for Facebook, Apple, who's the other A? Alphabet. Nancy is NVIDIA, and G, Google, right? FANG, it's a double A. So the Cheech and Chong trade, pot stocks have replaced that because this is where the hot money is chasing. And so far, depending on the company, it's been a pretty good speculation. Now, MJ is one ETF that tracks this sector, this group. I don't really even call it an official sector. It's an emerging group of companies. But these are companies involved in cannabis, and that's, of course, being explored in terms of medical usage and so forth. Recreational usage includes those types of companies. So MJ was launched in 2015. It's just started to come to life in 2018. It's been dead money for the past 2 years. But this is an area that's beginning to move. A speculation that has been paying off since the beginning of the year. So that's what's going on there on our Twitter feed. We've got that, reference to Tilray and what's been going on there. Also, the 4% rule for retirement savings desperately needs to be modernized. This is an article link that I linked up to at MarketWatch, a pretty good article. And I have a question from a listener, Robert, a longtime listener. So he asks, well, should the 4% rule for retirement savings withdrawal then become 2% in the coming recession? And my answer to that, Robert, is that the correct withdrawal amount in terms of retirement, the correct dollar amount for each of us is not a precise percentage or number, but rather variable. And I want all of you to understand this, that the amount that you withdraw in retirement, I know we like certainty, I know we like fixed numbers, but it's just not that way. Life doesn't work that way. So we're looking at a variable number. So it may be 4% during times that are nice, like right now. And if that continues, you can continue at that rate of 4%. Maybe it needs to be higher. I don't know. It depends on a person's lifestyle. It depends on your ongoing financial needs. It could also be driven by market conditions, right? If market conditions are friendly like they are right now, maybe you can take out a little bit more than 4%. But at the opposite spectrum, when market conditions change, you may have to pull out less because of that, so as not to deplete your assets and run out of money. And this is why it's so important to have a margin of safety inside your investment portfolio. A part of the overall portfolio that's fixed, guaranteed, principal protection, zero market risk, that acts as a column of strength when chaos ensues. When it starts raining cannonballs from the sky and people are getting slaughtered because they didn't remember this rule of having a margin of safety. And so this is the proper understanding of the 4% rule and the proper application of it. Remember that it's a variable figure. 4% is just a guideline. That guideline was invented over 25 years ago by some financial planner who I think was trying to do a good service. He had good intentions, but it's become an outdated thing because the world is not fixed. The world is variable. Everything that we see in nature is constantly moving. The ocean is constantly up and down. The atmosphere is constantly moving. Heck, the planet we live on is on an angle. It's tilted in space, and it's swirling. And so, unfortunately, that's the type of environment that we live in, and we need to adapt to that. And so we need to have an understanding of the proper way to go about that is to take into account have a variable distribution retirement plan. Now, that said, we can still have certain areas of our portfolio or investments or plan have fixed income distributions to us. For example, Social Security, right? That's a guaranteed source of income. Maybe you have a pension. That provides some stability in terms of giving us an understanding of, hey, this is money I can rely on. It's going to come in every month, regardless of whether the stock market is up or down. But in terms of the actual investments that we have at risk, we need to really think about this correctly and be prepared and have a realistic outlook. And I think a variable distribution plan is the right approach. It certainly prevents the worst-case scenario from happening, which is outliving your money. 844-305-7800 is the number. This is the Index Investing Show. I'm your host, Ron DeLegge. We're going to finish this conversation when I come back. The conversation of speculation. Go nowhere.
The Index Investing Show with Ron DeLegge.
You're listening to the Index Investing Show with Ron DeLegge. Go to IndexShow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
All right, welcome back from the break. This is the Index Investing Show, and want to finish this conversation about speculation and the context for correctly doing it. Yeah, you can correctly speculate. You can also incorrectly speculate with your money and investments. So the first rule is to speculate with money that you can afford to lose. So no matter how you cut it, the odds of speculative success, regardless of the asset type, regardless of the asset class, regardless of whether you think you've got an edge or not, the odds are stacked against you. Do not delude yourself. And so that's the first rule. You speculate with money you can afford to lose. Yet the danger of financial speculation goes beyond that. It's much bigger than that. The perilous threat is losing money you cannot afford to lose. And that's the trap that many people fall into, especially degenerate gamblers who try to bet themselves out of bankruptcy. It does not work. Speculating with money you cannot afford to lose is a great formula for poverty. The second rule of thumb is if speculating for profits is your main and only goal, you're doing it wrong. The sad and singular goal for some individuals is to secure great wealth through financial speculation. For example, certain people conclude that they'll never be able to accumulate wealth by saving and investing money the old-fashioned way. So they want quick profits. So whatever little money that they have, they spend it by gambling on lottery tickets or other speculative ventures. Financial professionals, by the way, are not immune to this syndrome. There's a lot of folks on Wall Street that suffer from this same syndrome. Wall Street's trading desks are littered with algorithms designed to capitalize on short-term movements in the stock market. In extreme market conditions, most programs self-implode. We've seen it in the past. We'll see it again in the future. It's one of those constants. In friendly market conditions, most of these algorithms will not beat a diversified equity index fund or ETF. And while the traders and programmers behind these trading systems that are so sophisticated, they argue, well, listen, we've created a new dynamic. We've created risk-controlled programs that can increase the odds of speculative success. Absolute hogwash. And by the way, they fail, at least on one level, and that is that their singular goal of all these systems, of all these fancy algorithms and sophisticated trading prop desks. Their singular goal, and this is where they're so flawed, is they're trying to gain great wealth from speculative profits. And they fail not because they're dumb, but because the math and the odds are stacked against them. That's why they fail. So the final rule is this. If you're going to speculate, only and always do it in your non-core portfolio. And as I teach on this program as well as in my online classes, you can enroll at indexshow.com, but I'm very explicit and very direct with how you should, I believe, put together a architecturally sound investment portfolio. But one of the things that I teach is that you should have 3 parts or containers. A core, which is your foundation and the most important part of your portfolio. Then you have a non-core, which complements that core. The non-core can be invested in speculative assets. It could be trading accounts. It could be individual securities, sub-asset classes, and so forth. And then you've got your margin of safety. So those are the 3 containers. But again, the proper and only context for financial speculation is within a person's non-core investment portfolio. And that means that part of the portfolio, it can invest with leverage. It can go short the market. It can invest in an undiversified, highly concentrated way. It can bet on cryptocurrencies. It can bet on individual stocks. It can bet on hedge fund managers, venture capital, whatever crazy ideas come to your mind. This is the context for that. The non-core portfolio. That's the only context for speculation. It's okay to speculate inside your non-core portfolio. That's the context. And so think about it this way. If a gamble within a person's non-core portfolio doesn't work out, the worst that can happen is they'll lose money. The silver lining, though, if there is one, is that those losses from financial speculation were contained or limited to the non-core portfolio. That person, that investor still has their core portfolio. They still have their margin of safety, right? They still have that at least. They didn't completely blow themselves up. And so we can begin to contrast this person that uses this framework for building an investment portfolio, the 3 containers, versus the person that makes the fundamental mistake of speculating with their entire portfolio. When they lose money, and the probability is high, because that's just the math for speculating, their losses are totally uncontained. Now think about this in warfare. When you get killed in warfare, there's no tomorrow. It's over. And the same outcome awaits those that do not abide by the rules for keeping financial speculation limited to their non-core portfolio. So in summary, wrapping this all up and tying it all together, what have we learned? We learned that financial speculation has a good side and a bad side. While the odds of success are very low, hitting the jackpot can be hugely rewarding. And hopefully, following the guidelines I've given you for financial speculation will enhance your own processes and help you to avoid getting burned. And when I say getting burned, what I mean by that is avoiding catastrophic losses. That's my definition of getting burned. Catastrophic losses, suffering catastrophic losses because you can't rebound from that. Catastrophic losses are a death blow. And so we can't have that happen to any of our listeners. 844-305-7800 is the number. @Index shows my Twitter handle. You can listen to our podcast. It's available 24/7 at our website, indexshow.com. You can also find us on iTunes, as well as YouTube and Google Play. If you can't find us, well, it's your own fault because we're everywhere. Now, in terms of specific speculations that have been pretty good, take a look at bears that have been shorting emerging markets. One of the few bearish areas that has been a huge payoff, much needed payoff for bears because there's not many good bearish trades these days, EDZ ahead by just over 10.5%. EDZ, by the way, tracks, it's the opposite of emerging markets. It's a bear 3X shares, aims for triple daily opposite performance to emerging market stocks. That's been a good trade. Now, in terms of another trade that's been bearish, ticker symbol CHAD, which aims for 100% daily opposite exposure to Chinese stocks. That has been a good area. CHAD, C-H-A-D, ahead by almost 16%. So Chinese stocks are in a bear market. They're in a funk. And so the momentum is on the side of bears. Keep your eye on CHAD. Going back to bulls, we've got TECL, which tracks technology stocks, aims for triple daily performance to that area. TECL ahead by almost 46% since the beginning of the year. That's been a great trade. Also, if you're long the S&P 500 with triple daily performance, SPXL is the ticker on that one, you're ahead by almost 25% since the beginning of the year. So another great trade. And remember, we're heading into October. October, I know, historically speaking, is a scary month. Do not trade seasons. Trade prices. Some of you look at the calendar and you say, oh, it's October. Bear market. Wrong. Watch prices. Watch market sentiment. That will be your guide in terms of how you should trade up or down. Well, that does it for another episode of the Index Investing Show. Be sure to join us again next week. Same time, same station. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producer.